Thursday, November 9th, 2023, Maneco 64, home of alternative economics and contrarian views. Today, we're going to look at whether London, and by London I mean the city of London, is losing its dominance over the bullion market, over the gold market. And it's had this dominance for over 350 years, believe it or not. Before I start though, I'd like to thank all of you for your interest in the channel. And for those of you who are new to the channel, make sure you subscribe if you enjoy watching my contents. And make sure you hit that little notification bell as well to be notified of all my new contents. Before we go into London and the bullion market, just wanted to quickly go through what's called the Sharpe ratio. What is the Sharpe ratio? Well, according to Wikipedia, or Investopedia, excuse me, the Sharpe ratio compares the return of an investment with its risk. It is a mathematical expression of the insight that excess returns over a period of time may signify more volatility and risk rather than investing skill. A lot of fund managers, hedge fund managers, they use this as a very technical ratio, of course. Economist William Sharpe proposed the Sharpe ratio in 1966 as an outgrowth of his work on the capital asset pricing model, calling it reward to variability ratio. Sharpe won the Nobel Prize in economics for his work on CAPM in 1990. So you can look that up yourself. I'm not going to go into more detail about the Sharpe ratio. The reason I brought it up is because the director of global macro at Fidelity Investments, he's recently published Sharpe ratios for the last 5 years. It's the five-year CAGR over the 5-year annualized volatility. So according to him, gold is done really well in terms of the Sharpe ratio. It's up there with hedge funds, macro CTA, and hedge funds market neutral Sharpe ratios. It's almost near 1. So what that means is over the last 5 years, gold has had very good returns and hasn't been that volatile. It's been very stable, and I'm not surprised because it's one of the reasons why it's been such a good store of value over thousands of years, because it's a stable store of value as well. So just wanted to put that out there for those of you who are interested in gold. And of course, I don't really see gold as an investment per se. It's more of savings or money, a savings instrument. So I'm not surprised that gold's Sharpe ratio has been up there with almost at the top. For those of you who are interested in Bitcoin, well, Bitcoin has a little more than less than half the stability and return of gold. You can see there it's beaten quite a few assets though. And yeah, check out Jurian Timmer on LinkedIn if you want to follow him. So back to the bullion market. The London Bullion Market Association, of course, is an association of the main bullion dealers in London, and it's been around for many centuries, and we're going to look into that in a second. But recently, we've seen news that all the Chinese banks that were members of the LBMA, they're like withdrawing from the price auction of the LBMA, and we're going to come to that in a minute. It's when they do the fix every day. They do it twice. They fix the price, and that doesn't really mean manipulating the price, even though they could technically. And this is Bullion Star reporting this. We've also had yesterday, there's a tweet here from Bloomberg, a reporter from Bloomberg, Jack Farchi. He says, the UK has just sanctioned 2 Dubai-based traders of Russian oil and gold in what appears to be a warning shot for the whole commodity trading industry. Well, we know what happens when you sanction not just countries, but traders as well. People just find an alternative. And we saw that with Russia, of course, vis-a-vis the Ukraine situation, the Ukraine war, if you want to call it. We're seeing this with BRICS Plus and the de-dollarization, of course. So I think, unfortunately, London, through the UK here, is shooting itself in the foot. And it has a lot to do with what's happening in the LBMA. There's a lot of speculation. Why have the Chinese banks disappeared from the LBMA? Well, maybe because they know they're going to be kicked out, and they want to make the move before they lose face. We know the Chinese don't like to lose face, so that could be the reason why. And now we're going to go look at history, because I've had the book that I'm going to show you for quite a while, and it's an excerpt of articles about gold in the Times of London from 1933. It's a reprint. And for some reason, I picked it up the other week and started reading it again. I've had it for many years. You can try to get it online. I don't remember where I bought it. I've had it for a long time. But, and here it is, Gold. Very nice book. And what does it say here? Well, yeah, reprint of the special number of the Times, Tuesday, June 20th, 1933. Yeah, and it has a lot of articles about gold, the gold standard, paper systems, nations in the council, a saying plate. And there is a chapter here about the London bullion market. And I read it the other day, and I thought about what's happening today, in today's world with the LBMA, and I thought, wow, this makes sense. And there's an old saying about he who has the gold makes the rules, right? And you see what I mean by that. So this is one of the excerpts then. It's on page 63, as you can see here, the London bullion market. It's not a very long chapter. If you don't want to listen to me, just skip to the market recap. But it shouldn't take that long, and it's quite interesting. London bullion market from a special correspondent. The earliest mention of the word bullion in London appears to be in an act of 1336, which was worded in the French of that time and meant a melting house or mint to which the metals should be taken. It was afterwards used as a general term to cover gold and silver in bars, brought in to a certain degree of fineness. And it is so used in an act of 1431. Up to the time of Henry VII, the amount of English coinage was very small, owing to the small supplies of local gold and to the seigniorage which monarchs took as part of their revenue. This sometimes became very large. Consequently, foreign gold coins became much more popular among the goldsmiths than local coins, and there is evidence that these foreign coins were also accepted as payment in many cases throughout the country. And here we go. The origin of the London bullion market is difficult to trace, but there is no doubt that it had been carried on for many years by the goldsmiths and money changers. By the reign of Charles II, the goldsmiths of Lombard Street and the licensed brokers of the City of London had undoubtedly reached a degree of considerable importance. It may be said that the bullion market proper dates from the Act of Charles II in 1666. So as I said, for over 350 years, 357 years to be exact, that London has dominated the bullion market, I would say. When the monarch, in order to make amends for the way in which Charles I had plundered them, surrendered to the goldsmiths the so-called free coinage, that is to say, the control of precious metals, and therefore the control of monetary policy. And 51 years after the passing of this act, the price of gold reached 85 shillings. I think it's shillings, 85 shillings per troy ounce. It was these same goldsmiths who were so antagonistic when the Bank of England was formed in 1694, especially to deal in bullion, bills of exchange, and forfeited pledges, and who went to the length of buying up large amounts of the bank's paper and presenting all together in 1696 for payments, and seriously inconveniencing the credit of the bank. Well, that's like a run on the Bank of England. It was only by resorting to the delays of the law that the Bank of England was able to gain time to make the necessary arrangements to meet this crisis. By the Act of 1816, silver was demonetized and gold decreed the sole measure of value in legal tender for any amount. This was undoubtedly the greatest date in the history of the bullion market. From the time of the adoption of the monometallic standard by this country from 1816 to 1914, England and the world in general, through London, attained a degree of economic, political, and social progress and prosperity hitherto unknown. Gold was in free circulation and was directing the monetary policy of the universe. From the establishment of a single measure of value from 1816 to 1914, money being freely convertible into gold and gold circulating freely was lent to all good borrowers without political interference. Money in that period was not looked upon as wealth, but as a mechanism to measure value and effect change. If the relation of the credit structure to gold, the measure, became strained, it was corrected by a liquidation and adjustment of the superfluous credit structure. These adjustments were frequent in this period and are essential and necessary for the preservation of a true measure of value. The bullion market of London throughout this period was the pivot and base of the world. Since the Great War, such adjustments have not been permitted to take place, and the credit structure built on gold today is such that one cannot see yet to what price gold will ultimately rise to establish the necessary relation between gold and credit. I'm going to skip here to the end because the next part they talk about who ran the bullion market, who were the firms involved, the characters, and it's interesting, but it's not really the point of what I'm trying to tell you here. I'm just going to skip here right to the end, and this is what this article says. Meanwhile, particularly since America abandoned the gold standard, London has once more proved itself the financial center of the world. At the present moment, gold is flowing to this country, and London is the only place in the world where it can be dealt in freely. So there you go, dealt in freely. I mean, you could argue whether it was dealt in freely in 1933, but my point here is that countries like Russia and many others, like the Emirate countries, other countries that deal in gold, they don't feel like the LBMA with COMEX as well involved really trade the price of gold freely. And maybe that's why we're seeing such a discrepancy between the Western or London price and the Shanghai price. I would argue that's the reason why. And I think it's a shame because if we allowed gold to trade freely in London and not manipulate the price of gold, I don't think this would be happening. But unfortunately, gold is so important as an indicator of monetary, how can I say, management, that the central bankers are killing, killing the goose that laid the golden egg. They're shooting themselves in the foot, and they are giving up the control of the most important monetary asset there is, and that is gold, to the rest of the world. How it will end up being, whether Shanghai is going to dominate, whether there's going to be several spots around the world that dominate the trading of gold, and whether they might manipulate it as well, is another question. So I think the significance of this is that this could be signifying the end of London as the center for gold trading or bullion trading. And as I said earlier, he who has the gold makes the rules, right? And I expect a lot of physical gold now to be flowing out or not flowing into London, because it's going to stay outside London. And I think that's going to force not just the LBMA, the bullion banks in the LBMA, but also on COMEX to start covering their synthetic shorts, their massive shorts. And why is that? Well, because there won't be as much physical to redeem for those who want the physical, because a lot of the physical is going to stay outside London. It's going to go to Shanghai or the UAE or to Moscow or even other places that we don't know right now that could come up and start trading gold. So there you go. That's what I wanted to talk about today. So with that, let's quickly look at where the markets are this morning. It's 8:32 a.m. London time. We've got spot gold at 1946. Yeah, very frustrating in the short term. But don't forget, gold is still up about, I think, more than 7% year to date in dollar terms. I know silver hasn't done as well this year. It's still down in the year. But be as it may, I think with what's happening in the background, it's more important than ever to hold on or even add on to your bullion positions. So the high overnight has been 1955 and the low 1944. Silver yesterday actually didn't do much, even though gold was down about 1%. This morning it's down about 12 cents at 22.40. High's been 66, the low's been 34. Dow futures is up 23. The NASDAQ is virtually unchanged, and S&P as well. To the currencies, sterling is down slightly at 122.75. The euro as well, down about a tenth, just below 107. The dollars continue to rise against the yen. It's now at 151. The dollar's up a tenth versus the yuan at 729. Aussie dollar is unchanged at 64.03. The dollar's up slightly versus the Canadian dollar, just above 138. And the Kiwi dollar is up 0.2% at 59.20. Commodities, we got WTI crude up almost 1%, just under 76. Brent is trading just above 80. It's up 1% as well. Platinum That's down about $3, trading around 869. And high-grade copper is down a third, trading at 365.90. Quickly go through the bond market. The U.S. 10-year yield is unchanged at 4.54. So with that, I'm going to wish you all a very good day. Take care. Bye.